Hi, I'm Doug Jones, and I have done lending since 1968. And there's been a lot of changes, of course, since 1968. And I've sat in front of thousands, excuse me, absolutely thousands of customers talking about their credit and showing them how to get into better financial situation. A thing that came out today in the news is that the credit card debt in America for the first time ever has gone over $1 trillion. And that means a lot of people are using credit cards, and a lot of people are going to have a lot of difficulty in making those payments on credit cards. And a lot of people are going to be stressed with the credit card payments. And you know, the bankruptcy laws have changed. It's not even easy to go bankrupt nowadays. So I want to show you some things. And what I'm saying is time to cut up the credit cards, because we've gone over $1 trillion, and that's, I had to look it up, that's 12 zeros, okay, 12 zeros. And one of the factors is the Federal Reserve rate. The Fed rate is now 5.5. It's gone up from 2.5 or so a year ago. The prime rate is 8.5. That affects mortgages. That affects credit cards. Credit cards are average, national average of 20.93. You imagine 20% off $1 trillion. Banks are pulling in a lot of money, but then again, they have a lot of losses in credit cards. Until 1986, it was legal, and it was just legal. Just you could write off the interest on credit cards until 1986, and then a new tax law came in, and you can't do that anymore. But everybody had credit cards in those days. I had a lot of credit cards at times. One time I remember, now this is going to sound very low right now, I had $14,000 in credit card, but my income for the year was only $9,000. So I had a lot more credit card than I did income. And it gets really, really stressful to make those payments. So I don't like it. And I'm sure a lot of people watching this don't like it. If you don't own a home, I just encourage you to really try to tighten up and not use the credit cards. Use one card and pay it on time. Try to get your rate, shop around for the cheapest rate credit cards, and then quit using credit for a while. Just tighten it up. At one time when I was young, married, had a baby, I worked 3 jobs because of credit cards and bills, and that's just what I did to make the payments. So, but if you're in Silicon Valley and you own a home, then there's another thing you can do. And real simple, I make home loans, second mortgage loans. I do lots of first mortgages loans, but a year ago or 2 years ago, the interest rate on those loans was 2.5% to 3%, and now that rate is over 7%. So it does not make sense to get a new first mortgage loan unless there's other reasons, you know. But you could get a home equity loan, a second mortgage, so to speak. And we did the blended rate. I've got a blended rate here. It's you can see the calculation, or if you can't write all this down, just go online and check blended rate, and you put in the balances you have on a credit card or a mortgage or a car payment, and then the interest rate, and it will give you a blended rate. So keeping your total cost down, blended rate, is what's really important. We used an example on the blended rate. We used a $500,000 mortgage at 3%. And then we used a $100,000 second mortgage at $100,000 at 10%. We used 10%. And that blended rate came out to 4.167. So right now, if you're paying 21% on credit cards, $100,000, you could take that, and you've got the equity. You could get a second mortgage, and you could get it at 10%, and then it's still your blended rate of cost of money is 4.167. So it's a lot better. And the second mortgage, now check with your CPA, because there's some rules where it can't happen. But most times the second mortgage is tax deductible, and this is not. In closing, if you got a lot of credit cards, get rid of them. Try to do your darndest to get rid of them. Get down just to a few credit cards, pay them on time, and try to get rid of them and shop around for the lowest interest rate. If you own a home and got a lot of equity, then consider getting an equity line. Or now an equity line, the problem with equity line is they're based on prime, and prime is now 8.5 plus a margin. They're going to be like 11.5. Fixed rate second mortgage, to me, is going to be a lot better. So I'm Doug Jones. I'm at Mortgage Magic and Buyers Realty and Doug Knows Real Estate, and I'll be glad to talk to you and assist you if you want.